The Australian government just released the biggest tax reform since 1999 and is going to have a massive impact on property investors, crypto investors. Every single person in Australia needs to be aware of what's going on. And I'm going to break down exactly what's happening for you as a crypto investor, as what is happened over the last few days is astonishing. I'm currently in San Francisco, just going hotel to hotel, and seeing what is going on back home in Australia is mind-blowing. The announcement that's come out a couple of days ago from Treasurer Jim Chalmers, by the way, a year ago they said they would not make any changes to the tax reform, but here they are today, and the government is planning to replace 50% of capital gains tax on assets held more than 1 year and completely wiping out the ability for you to hold an asset more than 12 months and save 50% capital gains. So I'm going to break down what's happening, what the differences are, what you need to know as a crypto investor, and then my personal strategy to optimize my tax position to make sure I'm not getting absolutely smoked by the government, which we already do. All right, it is absolutely mind-blowing. So first things first, what is actually going on? Jim Chalmers came out literally 3 or 4 days ago, and they have put together a proposal to change the way the capital gains tax works. Now, reported on Sunday, there's going to give us 4 months grace before these changes come to effect. It is very important to also note that the budget that's being pushed forward hasn't been signed off yet by the federal government. However, this is 99% going to happen. All right. So the big headline changes are pretty much from July 1st, 2027, the 50% capital gains discount that was applied to individuals and trusts and partnerships since 1999 will be scrapped. That is now going to be replaced by a cost-based indexation. So essentially your cost base of an asset will be uplifted by CPI rates that are held for 12 months or more, similar to pre-1999. And you'll have a 30% minimum tax on capital gains. So even if you are lower than the 30% marginal tax rate, you will be brought up to 30%, which is wild. All right, because the whole idea of this apparently was to like help the average Australian. But what it's actually doing is it's going to, especially on the property side, they've scrapped negative gearing. It is just going to be absolutely shit show, because people that own those properties are just going to increase the rent to the everyday Aussie they're trying to protect, that they've given them a 1% tax discount. You're kidding. All right. So this is how it works in practice. So pretty much, let's say before July 2027, if you hold a crypto asset for longer than 12 months, you got this 50% capital gains discount. All right. So if you bought at 100 and you sold at 200, you would have a total of $100,000 profit. Now, if you held over for 12 months, you would then get a 50% capital gains discount. So you would pay tax on the $100,000 profit. And depending on your marginal tax rate, let's say it was 47%, you would essentially pay 23.5% tax, all right, on that. Now, after July 27, there's no longer a 50% capital gains tax under your personal name or your trust. It's just gone completely. So that is no longer there. You're also copying a 30% minimum gain, all right? So even if you're on the lower tax rate, all right, you're going to pay at least 30% tax rate, plus the cost base will increase by CPI, all right? Basically, let's say you've got someone that, let's call her Sarah, right? And thank you to Adrian from Crypto Tax Australia, who provide our clients all their tax research. So I'm not a registered tax advisor by any stretch of the imagination, but Adrian has sent this over. So I'm going to go through this just a little bit more visual to help you guys out. So for the first 5 years, right, let's say she bought Bitcoin at $30,000 here, okay? And this was year 1, all right? At year 5, let's say that's worth $180,000, all right? Now, let's say at this point here, all right, before July, this is July 2027, she would pay $75,000 of tax because she gets the 50% capital gains discount. So she essentially here has $150,000 of tax, which she pays at $75,000. Now, let's say that she held that all the way through, and now she's for the years 5 to 10. All right, the cost basis of the asset at July 27 will now be calculated at that date. So even if you hold an asset all the way through, you will pay 50% capital gains for the prior period to July 2027, but after July 2027, you'll be on the new tax rate. So you don't need to rush out and go sell anything if you don't want to. You'll still get the tax position that we're currently in up to July 27, but afterwards it changes. So afterwards, let's say that cost basis at that point, all right, she's still got that $180,000 of Bitcoin, and that after, over 5 years goes to $300,000. This new calculation of CPI cost basis essentially means that the $180,000 that she had, all right, at that point in time, over the 5 years, is calculated at the CPI rate, which is 1.025, all right? 0.25 basis points. So you times the 180,000 times by the 1.025 times the 5 years, and you end up with your new cost basis. All right. So what they're kind of saying is like, oh, hey, like, you're not going to get the 50% capital gains discount, but like, we're going to give you like, 0.025% on your cost basis every year. Yeah, fucking thanks. Okay. So she's now got $203,000 cost basis. Then she sells at the $300,000. So she's got about a $96,000 gain. All right. That $96,000 gain. She's now no longer getting no discount. So Sarah, will now pay the $75,000, all right, that she was up to with the 50% capital gains discount prior to July 27. And now the new rate, she will cop $96,000 in tax. Now, the tax rate on that, essentially, depending on her marginal tax rate, will be different, all right? For me, it's 47%. I would pay, if I was Sarah, pay 47% on this 171, which combines them both, all right? 75 plus 96 please, equals 171. I would pay 47% on that after July 2027. Normally, right now, I would pay 23.5%, all right, under my personal name. Now you're going to pay the full tax rate. So here in this instance, well done, Sarah, for buying Bitcoin early. She's made $270,000, real profit, and she's going to give $170,000 in tax offers. Fucking wild, all right? So who does this impact, and what structure should you think about? Well, for personal, holding your crypto in your personal name, you're no longer getting the 50% capital gains discount. You're getting absolutely annihilated. Same on the trust. No longer do you get the tax on benefit on the tax. The tax benefit on the trust. So you'll pay a minimum of 30% tax on trust taxable income. So usually, like what would happen now, you have a trust, you bring those profits in, and you split to your children, low income spouses, whatever. That's now basically gone. All right, you have a bit of a rollover relief, but the thing that I am, doing and have done for a little while is owning my crypto in a company. All right. So by owning my crypto in a company, you only pay the company tax rate. All right. So that gives you to the 25% tax rate, right, of a company. And you only pay the top up to your personal name after you bring it out. So I can buy, back in this example, I would buy my $180,000 in my company. I get to $300,000 in profits. On the 96,000 here, all right, I would only pay my company tax rate. I would not pay my 47%. I would pay the 25% on the profit. The profits would retain in my company until I take them out, all right? The other thing as well as a company, if you have a business or you're earning income or dividends, you can move your profits into the company structure and you will get the franking credit. So let's say you got a business here. All right, let's call it Collective Shift, my business, okay? So I'm going to make profits, and here is... this is Ben's company. All right. So let's say Collective Shift, makes some money, hopefully. And, I send money from Collective Shift to Ben's entity, and that is coming across as dividends. So I will get franking credits on that. All right. So the company would pay its 25%, and then any profits I send over will come to my company with the 25% franking credits. All right. So now that money that I invest in there, I can build up and, grow my portfolio. Let's say, my $100,000 that I push over here ends up to $200,000. This $100,000 of profit here, I get the 25% on the franking credit. So I've already paid that 25%. And then I just pay the top up once I take the money out into, hello, Ben wants to, buy some McDonald's. So that way you're not getting the 47% upfront. That is very important. The other thing as well is that the bucket company structure is basically dead, and negative gearing from a property perspective is limited to residential property and basically is on the same rules. This is going to smoke Australians, because essentially what's going to happen is that the investors that own the property are just going to increase their rent to be able to cover the cost of the negative gearing piece. So what's going to happen is asset prices will probably go up, property will continue to go up, and you as a crypto investor need to think about the structure. So the three things I'd be thinking about, all right? First one is auditing your structure. Where is your crypto right now? What structure is it in? If it's in your personal name, I would be thinking about, again, I'm not a tax advice professional, please speak to your own tax accountant, but the way I'm doing it is if I would have any crypto in my personal name, I would be looking to basically sell that at the point of just before July 2027, and I would be optimizing at the 50% capital gains rate and then restructuring that into a company name. All right. So basically the things that we're looking at is, essentially taking those initial investments, rebuilding them in a company structure, taking advantage of the 50% capital gains tax. And then when in this structure here, rather than paying the no discount full clip on the profit I make, I've got it under a company structure. So that's the one I would be thinking about. The second one is SMSF. So SMSFs are not being touched here. So SMSF continue, so self-managed super funds, 401ks in the US, continue to be not impacted based on these changes. So the SMSF providers, essentially allow you to continue to grow your profits in there and not pay tax until, such point that you need to, either take it out early, or otherwise you essentially, from other SMSFs, you get taxed at that 15% rate. All right. So that is completely excluded from this update. And that is why the SMSF structure is a great one if you want to continue to build and accumulate assets in your super fund heading into retirement. And the other one here is the lock in the gains. If you've got some profits leading up to July 2027, I would be locking in those gains, paying down 50% capital gains and moving them over. All right. If you've got losses, all right, taking some capital losses and carrying them into, new assets, new structures, nothing changes in their treatment. So if you're carrying some losses in your crypto under your personal name. All right, future capital gains can offset those losses, but you're going to have more capital gains to pay in your personal name. So I would, again, probably looking at tax loss harvesting, moving them across, again, depending on how it's structured. The other part of this is, for businesses, business owners, and evidently anyone that's holding an asset, the 50% capital gains discount was a huge incentive to be able to hold and buy things long term. And I know a lot of people would hold their crypto, including me, in a personal name more than 12 months to get that 50% capital gains discount. So that being completely eradicated is very important. Now, something I do, and again, this is not financial advice, so I can't recommend this legally, but what I do with my Bitcoin now is I can lend against it. So I have my Bitcoin and I can lend against that Bitcoin by giving it to an intermediary, like, Block Earner as an example. All right. And by giving it to someone like Block Earner, I can then lend against that. They will give me, up to 30, 40% LVR, meaning I can get 30 to 40% of my Bitcoin in cash, and I'll pay the interest back to Block Earner. Now, what I can do with that is that I'm not selling my Bitcoin. So by not selling my Bitcoin, I'm not paying tax. With that money, I can go and do things with. I can invest in my business. All right. I can invest in Collective Shift. I can go on holidays. I can generate more income. Right. And with that 7% or 8%, whatever I'm paying back to Block Earner, as long as I'm covering that 8% with the money I'm taking out, it's net positive. Also, your Bitcoin continues to grow and compound. So you're not selling your Bitcoin that you're lending against. And historically, Bitcoin's, growing at 40%. It's going to cover the cost of the loan if that continues. Again, this is not financial advice, this is what I'm doing, but it's a great way that you can continue to grow your assets just like the wealthy do without having to sell your assets and not getting stung on the tax. On the personal tax cuts, this is the thing that just makes my blood boil. The whole idea of why, this government wanted to do these tax reforms was to help the everyday Aussie. Well, guess what? The everyday Aussie is just getting smoked. They're getting a $250 tax offset. Fucking awesome. All right, great. There's a happy meal. And they're getting a 1% deduction on the tax rate, on the lowest tax rate. I can't remember the exact level of income that is. But basically getting a couple of $100 as well. So they're saving $500. Meanwhile, the people that, are going to be most affected are those that are doing negative gearing, that are, buying property. It's going to be harder for the everyday Aussie, in my opinion, to buy property. And then those that are already negative gearing and now have 12 months to figure out how they're going to pay for the offset of rent that they need to cover that now doesn't offset their tax. So they're going to probably raise their rent, or they're going to sell the property. So the property market is going to have a big impact. We've seen already the Australian stock market have a sell-off. Like, it just doesn't make any sense to me, and as a business owner as well, like, wanting to build Collective Shift and, who knows, one day what happens, gets acquired. You're now paying, you're not getting any, there's no benefit. You've now got the government as a shareholder on your cap table. It's just absolutely wild. I just do not understand what they're trying to do. So those are the biggest things you need to be aware of. All right, July 27 is the date. Again, this hasn't been officially signed off from the government just yet. However, but it will be. And the tax reforms, have just been released in the last few days. So you've got until, the end of June 2027 to do it. Make sure that you've got a evaluation by the end of that. I would recommend, chatting to Crypto Tax Australia. If you're a Collective Shift member, you get access to a free session with Crypto Tax Australia, a free 30-minute session that is over under resources, and discounts. Get a free strategy session with them. If you want our support and our guidance on the research and, what we do with over 1,000 clients as a co-pilot to help you navigate the world of crypto and, invest and have access to the, early stage markets, to the DeFi projects where we have all our investments, our portfolios compounded at over 116% over the last 6 years. And we do things like income and yield and, really able to optimize people's digital asset portfolio, which is more important than ever, considering the bank is giving you 3% and the government's taxing you even more. It's now more important than ever that your investments are working for you. That's exactly what we do. It's what we teach. If you're interested, I'll put a link in the description below. Let me know what you think about this crazy, crazy, crazy bill in the comments, and we'll see you in the next video. Thanks, guys.